You've been learning about value investing, finance, just regular investment for a while now, but you don't know where to go next. You're getting confused about the vast amount of information on the internet. You don't want to waste your time on crap information. You want good information and reliable information. In this series of videos on value investing and finance education, you will find those answers to those questions and much more. My name is Jason Rivera. Welcome to Value Investing and Finance Education. Hey, Jason here. Today I'm going to tell you the 6 reasons that most value investors do not short sell. Before we get to that, I need to let you know that this series is available as a podcast, the I Love Value Investing podcast, anywhere in the world for free on all major podcasting platforms, iTunes, SoundCloud, Stitcher, Spotify, Anchor, and more. Available anywhere in the world for free on all major podcasting platforms. So, before I get to the 6 reasons most value investors don't short sell, I need to tell you what short selling is if you don't know what it is. When you short sell, you're betting that the stock will go down, usually to zero. So essentially, when you go what's called going long, when you buy normal shares on your brokerage or whatever, it's called going long, and you expect the company's shares to go up over time. When you sell short, you expect the shares to go down and preferably to zero over time. So there's kind of the basic definition of short selling. Most value investors don't do it at all. I don't think Warren Buffett's, I've read all his financials, or not all his financials, every single one of his shareholder letters. I don't think he's ever short sell that I can think of. Most value investors do not short sell. Today I'm going to tell you the 6 reasons why most value investors don't short sell. Number 1, potential for unlimited losses. Yes, this is theoretical. Yes, you would be wiped out before you have unlimited losses, but while a share's price can go down only to zero, in theory it could go up forever. Yes, again, this won't happen, but if it continues to go up and up and up, you're going to get wiped out at some point, no matter what size you are. Companies during the right before the Great Recession, with hundreds of millions or billions of dollars betting short that the subprime market was going to crash, almost got wiped out because their timing wasn't right. They had to wait years instead of months. So you can get wiped out really fast as a short seller. Reason number 2 is margin. Margin is when you pay interest for the right, I guess is the right terminology, for the right to short sell a company. This is a must. You always pay interest, but interest rates do fluctuate based on liquidity and size of the company and short seller interest, that kind of stuff. But you do see interest rates up to 20%. So let's say you buy $1,000 worth of a company's shares. If you have to pay up to 20% interest rates, that means you would have to pay $1,200 to short a stock that you wanted to short at $1,000. So you're immediately down, meaning you lost $200. Think of margin as negative leverage. I talk about positive leverage in terms of investment float and using your assets and knowledge and information wisely. I always look for positive leverage. This is negative leverage. This is like credit card interest rates. Think of it like that. So that compounds on to the first point of potential for limited losses. Margin compounds on that. So let's get to number 3. Even if the stock is terrible, absolutely horrendous, the worst company you've ever seen, it can still get bought out by a bigger company and you would still be crushed because the share price would likely be at a premium to what you shorted the shares at. So how does this happen? A real world example is a company, let's say it's worth $25 million on the stock market. It goes down to $15 million. Great, you're looking all right from a short seller perspective, but then it gets bought out for $30 million. You still hammered because the company got bought out at a premium to what you shorted the stock at. And If the company gets small enough, that means bigger companies can buy it and it won't really matter to them. They can look to turn it around. They can look to integrate it into their own operations. They can look to license their technology if they buy it out, or to acquire the licenses and patents, whatever it has. So the smaller a company gets, in most cases, unless it's a dying industry, sometimes the higher probability it is that it's going to get bought out because the deal becomes cheaper for them. If the company gets bought out, you as a short seller, still crushed. So there's 3 reasons. Let's go to number 4. It can take years or decades for an opportunity to happen, and you can get crushed in that time period. Again, this happened before the Great Recession, if you've ever watched the movie The Big Short. Michael Burry and I can't think of the other guys' names. Eisman? Steve Eisman, is that one of them? Put literally hundreds of millions or billions of dollars at stake to bet against, because they knew that based on their information and their reading of the situation, that the stock, or that the subprime housing market was going to crash and going to take the economy with it. But they were wrong on the timing. So even if you're right, you have to be right on the timing when it comes to shorting. They lost, or they potentially could have lost if their timing wasn't a little bit, or was a little bit worse. They could have lost billions of dollars. Instead, they had to wait, instead of months, they had to wait years for these bets to pay off, and these margin calls and things I'll talk about next, building up. Their fees kept building up, their interest rates kept building up, the margin calls, all that. They had to keep putting more money into these situations just to stay solvent in the short sellers market, to be proven correct in the long term. So if your timing isn't, even if you're right, if your timing isn't right, you can still be hammered. There's a quote by John Maynard Keynes, economist John Maynard Keynes, is the market can stay irrational longer than you can stay solvent. And this is even if you have hundreds of billions or millions of dollars. So why, as a smaller investor, would I even consider doing that if people with billions of dollars can get hammered when short selling? There's 4. Number 5, this is a personal one of mine, is the constant worries of having to wonder what your stock or the short selling stock is doing every day. I don't even check my share prices every day for the stocks I own. I just check for major news. I get Google alerts set up on my phone. Major happens, I get an alert. If not, I just kind of keep doing what I'm doing and keep working to improve and keep working to learn and improve my businesses, stuff like that. I don't pay attention to my stock prices on a daily basis, so this would literally drive me insane, worrying every single day, every single minute of every single day as things fluctuate, that, ooh, I'm going to be wiped out, ooh, I'm losing more money, what's happening, blah, 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 blah. It would literally drive me insane. So I personally don't have the temperament or mindset for it as well. I like kind of buying the stock, letting it sit there as long as nothing major bad is happening. And again, barring some kind of special situation that I don't have to watch very much, I just kind of like sit back and keep working, moving forward. I don't like worrying about decisions I've already made. So this is a personal one of mine. So that's number 5. Number 6, added massive unpredictability in the form of margin calls, which a margin call is, one example I saw online while doing research for this video was, if you buy at, let's say, $20, or you short sell at $20 a share, and it goes up to, the share price goes up to $21 a share, for every dollar rise in the price of the shares, you have to put 50 cents down in collateral. So this compounds fast. If you have tens or hundreds of thousands or millions of dollars in shares that you're selling short that keep going up, you have to continually put more and more money in. So this is why companies with hundreds of millions of billions of dollars can go bankrupt very fast if things change and the share prices continue to rise. On top of that, there's short squeezes, which are, an example is, let's say a company you shorted at $20 a share again, it gets some great news, great quarterly earnings that were unexpected, and you rise to $30 a share. So more and more people are piling into it for momentum's sake. You try to sell and you try to go long on the stock instead, which continually further and further rises the prices. So you can get what's called a short squeeze like that when prices continue to rise as momentum or as emotion or as earnings or whatever improve. Short sellers can get hammered that way too. And also, if the stock pays a dividend, split shares, split stock, spins off shares, issues bonus shares to shareholders, you as the short seller have to pay that as well. You have to pay those fees to the people who are long as well. So those are the 6 reasons I do not personally. I've never shorted a stock. These are the 6 reasons why most value investors do not short stock. And frankly, it doesn't make, again, it's just a personal temperament. I'm not built for this, which is why I'm biased against it, but it just logically doesn't make sense either. If people with hundreds of millions or billions of dollars can get hammered because of the factors I mentioned, why would I as a smaller investor even attempt to do that? And it's not like these are uncommon things. These things happen all the time. These factors happen all the time, especially with the market going straight up for the last 10, 11 years, whatever it's been. Perfect real world example of that for me personally is I wrote an article probably 4 or 5 years ago now about KOSS. KOSS is the ticker. They made headsets, earphones, kind of like these, except these are Sony and these are better quality than the KOSS ones. They were, at that time, I called them the worst company I've ever evaluated. There was legal issues with people embezzling money. There were massive restatements on company financial statements over, I think, years. They had to restate the financials because they were all messed up. They weren't going to accounting rules. They were losing massive market share to companies like Beats and Sony and all these other headphone companies and Bose, stuff like that. And they were a tiny company. I think they were a $25 to $50 million company at that point. So at that point in time, I called them the worst investment I have ever seen because of all those issues. I didn't short them for these reasons. I could have made money, a lot of money on them at this point, but I'm perfectly comfortable with my decision not to because, again, if Apple or Sony or Bose or whatever wanted to, $25 million is nothing to these kinds of companies. They could buy them like that and it would be nothing. And then immediately I would be hammered. So yes, while I could have made money on it in the short term, in the long term, I would be constantly worried about, are they going to get bought out? Should I hold on longer? Should I sell now to lock in gains? If I sell now, am I going to be worried, or am I going to be disappointed when they go to zero and then go bankrupt? That kind of stuff. I don't have the temperament for this, but that is a real world example of where I could have shorted one and I purposely chose not to for these 6 reasons. As a value investor, as a fellow value investor, I'd love to hear your thoughts on these 6 topics. Let me run those down again. 6 reasons why most value investors don't short sell. Potential for unlimited losses, margin. Even if the stock is terrible, it can get bought out. It can take years or decades for an opportunity to play out, so you can get crushed in the meantime. Constant mental worries and temperamental issues for me. I don't have the temperament for this. And added massive unpredictability with things like margin calls, short squeezes, that kind of stuff. I'd love to hear your thoughts on this. If you're a value investor, have you ever sorted something? Have you ever come across a company that you wanted to short that either went well and you would have made money, or you would have lost a lot of money because it got bought out or whatever? Love to hear your thoughts on this. Love to hear your thoughts. If I miss anything, and I may have missed something, I don't short sell, so I'm not as familiar with the terminology, which is why I have notes over here that I'm reading off, that I took and did research on this. If I missed something, let me know. If I need to correct something, let me know, so I can do it in the comments. Make sure to like, love, share, subscribe if you want to get all of our videos as they release. And we're releasing new videos all the time. And again, make sure to listen to this as a podcast as well, the I Love Value Investing podcast, and like, love, share, subscribe, and comment below. I'd love to hear comments. I read all comments and answer them myself. Thanks for watching. Have a great day. Talk soon. Bye.